Hello, everyone. Welcome back to the Weekend Charts, a special edition today, which I call the State of the Markets, June 2025, first day of summer. Perfect time to review everything going on in markets. We're going to be talking about stocks, bonds, the Fed, real estate, housing, commodities, currencies, crypto, intermarket analysis, and we'll end with the U.S. economy. So let's start out here with stocks, looking at the U.S. stock market, S&P 500, yet another bear market this year. So 21% decline from the February peak to the April 7th intraday low. What was the reason attributed to this? You know it, of course, tariffs, trade wars, global recession fears, and similar to the last time we saw this, which was back in 2018, similar type of decline, similar reasoning for the decline. We saw a rip-roaring rally off of the lows. Actually was one of the biggest 9-week rallies we've seen for the S&P 500 going back to 1989, 18.5% gain. So very similar to what we saw in 2020 so far, with the market rallying ferociously off of those lows. And if we look at the volatility index, the VIX, absolutely stunning collapse in the VIX in terms of 9-week declines on a percentage basis, 63% decline from a 45 level down to 16 and change over a 9-week period. We've never seen the VIX decline that much over a 9-week period. If you look 1 year later, what tends to happen following these big VIX crashes? Well, you tend to see the market continuing to rally going forward on average. Of course, there's always exceptions. We can see 2008, 2001 being the primary exceptions there. So if we take a look at the major U.S. indices here, NASDAQ 100 back above its 200-day moving average. You can see there's the bear market. There's the huge rally. S&P 500, same here. Big decline, big rally. Russell 2000, a little bit different if we're looking at small caps, and we'll talk about them in a little bit. Big decline here, and the rally back has not yet recovered its 200-day moving average. So in terms of relative weakness here, definitely small caps continuing to be weak, while large cap U.S. overall with the S&P 500 and the tech-heavy NASDAQ 100 doing much better. Now, what's driving this recovery? Of course, there was a change in stance in terms of the tariff policy. There remains uncertainty, but much less uncertainty, of course, than what we had in early April, which drove those big declines. And what we're seeing in the past few months is really a return to focus on U.S. corporate earnings. And if we look at those first quarter earnings, they're actually pretty good overall. We saw S&P 500 operating earnings on a trailing 12-month basis hit yet another record high in the first quarter, up 9.6% over the past year. And if we look at the estimates here for the remainder of the year, people are expecting earnings to continue to go up, and we're going to get about 10% earnings growth for the year if these estimates pan out. Now, I will note that over the past few months, these estimates in terms of what earnings will be have continued to trend lower. So this was much higher a few months ago. People are actually expecting 20% earnings growth near the end of last year, and now we're down to 10%. So we'll continue to watch that in the coming months. Are these going to continue to come down in terms of the estimates for the rest of the year? And we'll see how the market reacts to that if that actually occurs. So if we're talking about valuations here, the last time I was talking about valuations, we had that correction, bear market, and we saw a little bit of a contraction. You can see it here in terms of the S&P 500's price to earnings multiple was pretty minor, very quick, and you can see very quickly recovering in terms of that valuation. So where does that leave us? Around 25 times trailing operating earnings for the S&P 500, still well above the historical median since 1988. We're looking at 18 and a half. So still valuations well above that historical median, looking at trailing 12-month earnings. And if we look at the CAPE ratio, which simply smooths earnings over a 10-year period, you can see here at 35, well above the historical average of around 19. Of course, we've been above that average pretty much since 2009. But the question is, well, how far above it? And now we're at levels we saw obviously last year, we saw in 2021 before the 2022 bear market, and then before that, you have to go really to the late 1990s leading up to the 2000 peak to find comparable CAPE ratios today. And what do you tend to see in terms of valuations and then future returns? Well, the best we can say is that the best returns historically tend to occur when you have the cheapest valuations in terms of this CAPE ratio, looking at 10-year forward returns, and the lowest average returns, they're not negative on average, they're still positive, but the lowest returns tend to occur from that highest decile of valuations, which is where we are today. Now, this is an important thing to note here. It tells you nothing about timing in terms of when these returns will occur. Anything can happen in the next few months, the next year. Valuations are not predictive of that whatsoever. All they simply tell you is over a long period of time, let's say the next 10 years, you should probably temper your expectations if you're assuming that the valuations are going to revert to the mean and come down over that period of time. So that will take away from the overall return if that occurs. But if you don't believe valuations are going to mean revert, if let's say 10 years from now you think the CAPE ratio is going to be where it is today, which is certainly possible, then your return is simply going to be, well, what is the earnings growth for the S&P 500 over the next 10 years plus whatever the dividend yield is. So where we are today, definitely above historical averages. And the main reason for that is continued optimism, I would say, over the AI revolution and what that will do to corporate earnings. So still very high expectations there. And as I said, earnings expectations coming into this year were very high, looking for 20% earnings growth this year. Now we're down to 10%. So really the question in terms of that AI earnings boost is when is that going to occur and how big is it going to be? Now, if you're worried about U.S. equity valuations, if you're wondering, well, what's the best thing to do about that? Well, if we go back to 2000, a similar case could be made to say, this is a time where you want to have a diversified portfolio and not just be concentrated in large cap US growth stocks, which admittedly have done extremely well over the last decade. But let's say this valuation becomes a factor going forward, you're going to wish that you had something outside of that area in your portfolio. And so far this year, that's been international stocks. First time we've really been talking about this type of outperformance in a long, long time. But you can see here, leading up to this year, we were talking about the longest period of U.S. equity outperformance in history, 16 years running. And then you can see the reversal here with international stocks outperforming U.S. stocks. And you can see it's a pretty sharp decline and started pretty much day one of 2025. And if we look at that differential, pretty stark here, looking at the MSCI World, excluding U.S. equities, up 17%. Year to date, with the U.S. S&P 500 up 2%. And if we're looking at the spread on a rolling 5-month basis, I looked at this at the end of May here, you're talking about a 15% plus spread between the two. You got to go back to 2009 to find a similar 5-month period with a spread this big. So really historic outperformance of international versus U.S. so far this year. And we know what preceded that was a long period of U.S. outperformance. So this is not by any means erasing that. There's still a long way to go in terms of reversing this huge trend of U.S. outperformance, but definitely notable in terms of the last 5 months and year to date, this huge outperformance by international stocks. And I just want to highlight this country equity table here that I often put out, and this is the first time we've been in June, and I've seen the U.S. in this right column here, the bottom third. So U.S. stocks again up 2% so far this year, but you can see trailing the things like the Eurozone by a huge amount. Eurozone equities up 24%. This is all in U.S. dollar terms, so it includes the dollar's decline and the increase in the currencies like the euro and the yen so far year to date. But we're just seeing this pretty much across the board, particularly in Europe. Here you can see Poland leading the way with a 43% gain, Greece in second place here, 41%. Spain up 39%. So huge returns outside of the US pretty much across the board. Emerging markets outperforming as well, up 12% year to date. And you have that S&P 500 up 2%. So if we're looking at the Mag 7, which obviously in 2023, 2024, the big story was the enormous outperformance of the Mag 7 versus everything else, versus international, versus US, versus equal weight. It was really a story of domination of these 7 stocks in the Mag 7. This year, you would have to look and say mixed performance here. Now, this is very different than what we were talking about at the April lows, where all of the Mag 7 were really underperforming. Well, since then, we've seen a divergence here with things like Meta up 19% year to date, outperforming. Microsoft up 14%, Nvidia up 8%. So we've seen a huge comeback in those 3 names. But you have on the other side, Amazon down 3%, Google down 8%, Tesla down 20%, and Apple down 21%. So huge divergence in the Mag 7. We haven't seen this in quite some time. They have been tending to move together in tandem. And so this is a big difference. And I think one of the big reasons is the impact that people are expecting from the tariffs seems to be greater in terms of the expectations for Apple, in terms of higher prices, Tesla, versus some of these other names, software-related names like Microsoft. I guess the expectation is the impact is going to be less there for names like Microsoft and Meta. So still a lot to go in the year, but definitely notable that we're seeing the Mag 7 not moving as a group, seeing a divergence there. And if we're looking at growth versus value, and obviously the Mag 7 having a big impact on this chart and the huge outperformance of growth versus value in recent years, we actually hit, coming into the year, we were at its highest level since March 2000. March 2000, of course, being the dot-com bubble peak. But you can see this move lower here was the move down to the April lows in terms of growth stocks were underperforming value stocks pretty sharply at the April lows. But since then, we've seen a reversal with growth stocks pretty much regaining almost everything they lost. So still at elevated levels if we're looking at a ratio between the two of growth versus value. And within that growth sector, of course, you have the big tech names driving a lot of that. And we're seeing a similar movement here where tech was underperforming and then a huge reversal off of those April lows with tech outperforming. So you can see ratio of tech to the S&P 500 now back above the March 2000 peak levels. So if we're looking at year-to-date performance in terms of sectors, once again, we have tech now outperforming after that huge rally from the April lows. We have industrials leading the way up 8%. And on the downside, healthcare down 3% year-to-date and consumer discretionary down 6%. Tesla being a part of that and Amazon as well. So the sector picture, most sectors positive year-to-date. We have these 2 outliers. Overall, S&P 500 up 2%. And within the tech sector, semiconductors, of course, the last decade have been the big story there. Best performing industry group by far, led by Nvidia. But interesting to note that the relative strength of semiconductors actually peaked a year ago in June 2024. And you can see the underperformance of semiconductors over the past year. Now, this over here is the April low, so we've seen definitely a rally back, and Nvidia has climbed out of that hole, is up 8% now year to date, so driving a big part of that. But still interesting to note that over the last year, semiconductors underperforming the broad market. Now let's talk about large versus small. And we saw that huge reversal in US versus international so far this year. What we're not seeing yet is a reversal in this other long trend, which is large caps versus small caps. You can see a few months ago, this hit its highest level since April 1999. That was the peak in this ratio, after which small caps outperformed for a decade after that going forward. But you can see here, it's been the opposite the past few years in particular. Large caps outperforming small caps by a very wide margin, and that's continuing so far this year. So if we look at the year-to-date returns, small caps definitely notable, lagging down 7% here, and looking at the S&P 500 up 2%, and once again, international MSCI World ETF and international developed up 17%. So big spread between the two. And what will be interesting, I think, to watch in the back half of the year is, do small caps catch up here? Do they start to rally? I think the big perception of why small caps are lagging is the perception that tariffs are going to hurt smaller companies disproportionately versus larger companies, and U.S. stocks as a whole lagging international seems to be on the theory, in part, that U.S. companies are going to get hit harder based on those policies. Now, will that actually be the case? That remains to be seen. If it's not, or if these policies change, of course, we can see a reversal in terms of performance. If you're thinking about your own portfolio, how you should be positioned for the next year, for the next 10 years, for the next 20 years, at Creative Planning, we can help you with that and much more. Reach out to us today. I'll have a link in the show notes to get a free wealth path analysis. When you fill out this form, go to creativeplanning.com/Charlie for this free wealth path analysis. At Creative Planning, we're in all 50 states, so we likely have a location right near you. Over 350 billion in assets under management and advisement, and we're here to help. So go to creativeplanning.com/Charlie to get your free wealth path analysis. Let's move on, talk about bonds, Fed, inflation. Bond market, of course, very different story in recent years than the stock market. Bond market is still in its longest drawdown ever, now 58 months and counting. It seems very likely, unless there's just an unbelievable rally in the next 2 months, which is not likely, that we're going to hit 5 years in terms of this drawdown. So it started in August 2020, and seems likely we're going to hit that 5 years of a drawdown for the bond market. You can see here, definitely has improved over the past year. We're now in a 6% drawdown. The peak drawdown was 17%. So definitely better today, but still 6% to go to get back to new highs for the bond market. If interest rates don't really change and they stay where they are, that's going to take about another year and a half for the bond market to claw its way out of this historic drawdown. You can see nothing is close to this in terms of looking back in history, going back to 1976. The bond market has always recovered much quicker than it has here. And what's the big difference? Why is it taking so long? Well, interest rates were at historic lows back in August 2020 at a 10-year yield below 1%, and that huge rise in interest rates off of those historic lows created the biggest drawdown in history, so harder for the market to recover. But if we look at the past year or even year to date, bonds are doing just fine. If we look at the aggregate bond ETF, it's actually up more than the S&P 500, up 2.9% right now overall. And we look at the last year, it's actually up 4.1%, so right around where its yield is, which is about 4.5%. And what's leading in terms of the bond market, it's actually interesting. Emerging market local currencies is actually the #1 performer in this bond ETF table. And a big part of that is the decline in the dollar, increase in emerging market currencies, in addition to strong performance on the underlying bonds there. You can see EM sovereign debt that's in US dollars is #2 on this list. And looking at the bottom of the bond market returns, you have the zeros ETF, which is a long duration ETF, which simply means that it's tracking long-term treasuries, zero coupon treasuries. And because longer term yields in the US are up, if you look at the 30-year, we're talking about it crossing above 5% recently. That's the reason why these zeros are down a few percent so far this year. And if we look at the 10-year treasury yield, this is what people are watching very closely here, see what direction we break in terms of the 10-year. We're kind of been trading in a range here over the past few weeks. We're at 4.38%. Looking at that real yield, 2.07%. So pretty strong yield adjusted for inflation expectations above 2% for bond market investors. But the big question is this going to come down? Is this going to, or is this going to go up? And there were some fears, and the bill hasn't passed yet in terms of if they do pass a bill that adds to the deficit. It's going to add to the debt. What's going to happen to that 10-year Treasury yield? What I'll say here about the 10-year, it's still very interesting that the 10-year is significantly higher than where it was when the Fed started cutting interest rates last September. So it was about 3.6% back then. Now we're at 4.4%. So interesting that the bond market is kind of saying to the Fed, maybe you shouldn't continue to cut, and they've been on hold so far this year. So if we look at bond market returns versus yields, very strong correlation historically. This is the most important factor if you're a long-term bond investor. This is really all you should be thinking about. What is that starting 10-year Treasury yield? And again, we're about 4.4% right now. Well, what has that meant historically? Well, on average, over the next 7 years, you tend to get about 5% per year going forward. That's an average, right? There's range within that, but a very high correlation, 97% correlation between that starting yield and your future return. So much better place than where we were a few years ago when yields were less than 1% on the 10-year. So predicting less than 1% annualized returns going forward. And that seems to be on pace for what's actually going to happen today, in a much better place for the bond market. You should be expecting between 4 to 5% per year if you can hold your bonds over the next 7 years. In the shorter term, bond market is entirely dictated by the direction of interest rates. So if the 10-year yield goes up to 5%, let's say in the next few weeks, bond prices are going to come way down in the short run. If the 10-year yield goes down to 4%, bond prices are going to spike. But in the long run, over 7-year period, what you see is that return tends to actually be what that starting yield was, or come very close to that. So that's what you should be looking at if you're a bond investor, thinking about 4 to 5% per year over the next 7 years. And if we look at high yield spreads here, very interesting that even during that 20% correction for the S&P 500, we didn't see a huge spike in terms of credit spreads, and we got up to 461 basis points, but that wasn't even at the historical average in terms of spread. So investors were not betting on a recession looking at the credit markets back in April, and since then we've just seen a sharp move lower in terms of tightening of credit spreads. Now we're down to 316 basis points. So where it stands today, absolutely no fear embedded into the high yield market. Investors very much saying that there's going to be low defaults going forward. Not a lot of fear priced into the high yield bond market at all. Let's take a look at the US yield curve here, looking at the 10-year, 2-year, and the spread between the two. And of course, we had the longest period of inversion in history where we saw the 10-year yield below the 2-year Treasury yield for the longest period ever, but that snapped out of it last year, and now we have a positive yield curve once again with the 10-year above the 2-year. And what we've seen is a gradual steepening, let's say, over the past year. We're at 44 basis points now, the spread between the two. And why is the 2-year yield trending lower while the 10-year is kind of staying sideways here? Well, the expectation is that the Fed is going to resume their interest rate cuts starting in September. And here's the curve showing what the market is expecting here. They're expecting 2 rate cuts before the end of the year. They're expecting one in September and one in December. That would bring the Fed funds rate down to around 3.75 to 4%. And if we look at next year, they're expecting in 2026 2 to 3 rate cuts. That's where it stands right now. But in terms of what the market is expecting, really what you got to focus on is the very short term, because all of these odds can change, these expectations can change as the data change, as the Fed commentary changes. So really looking at that July meeting, it's on July 30th, so still have some time between now and then. The market as of today is pricing in an 88% chance that the Fed continues to hold interest rates at 4.25 to 4.5%. And what they're saying for September here is there's only about a third chance that the Fed will stay on hold, and 67% chance that the Fed is going to cut interest rates. Some chance, interesting, that they're saying maybe a 50 basis point cut, but the highest probability seems to be a 25 basis point cut. Now, that would not be a huge shock because looking at the Fed's projections, which they just updated in their latest FOMC meeting, they put out these projections every quarter, and they stuck to the projection of 3.9% for the Fed funds rate by year end, and that would imply 2 interest rate cuts this year. Now, interesting that they're still saying 2 interest rate cuts this year, but they raised their inflation expectation here in terms of core PCE up to 3.1%. So it had been 2.8%. They raised their expectation up to 3.1%, but they're still saying that they're going to cut 2 times. And so why would they do that? Well, it seems to be their projections for growth and unemployment, which the real GDP projection went down to 1.4%, and their unemployment rate projection up to 4.5%. So as it stands now, the Fed is saying even if inflation goes up over the next few months or the remainder of the year, they're still going to cut if they see weakness in terms of the unemployment rate or the economic picture in terms of real GDP. Now, the Fed is always looking at, and this is a criticism that I often make, they're very focused on what has happened over the last year. So they pretty much erase from history, erase from memory what happened before that, and are simply looking at, okay, what has happened over the last year in terms of inflation? And what they're arguing is that it's getting closer to that 2% rate. And even though they haven't got to 2%, they're saying they're confident it will trend towards that direction and remain there. Now, they don't have the confidence yet, which is why they haven't resumed cutting interest rates. But if we look last year, they seem to have the confidence enough to cut 100 basis points. As we talked about, the bond market since then has said, well, that's probably a wrong decision because we saw the 10-year Treasury yield rise. So what the Fed is essentially saying, if they're going to cut interest rate this year, is that they expect longer term that core PCE or overall CPI to get to that 2% target number. And the last year is going to be driving that. And why do I say the last year is going to be driving that? Because there's no evidence whatsoever over the last 5 years that we've gotten anywhere near that 2% target. So looking since January 2020, looking at overall CPI in the US, you can see we're 11% above a 2% trend line. So had inflation come in at 2%, you'd be on this blue line right here. What has it actually been? It's been 11% above it. So we've actually seen 4% inflation since the start of 2020. So in my view, the Fed shouldn't be thinking about cutting interest rates until we start to meaningfully close this gap. Otherwise, don't have a 2% target for inflation. You have to raise it and say, no, our new target is 4%. But if you're going to have a 2% target for inflation, you can't just look at the last year. You have to look at the average over multiple years. And since January 2020, we've seen actually double their inflation target. So we'll see what actually happens. It seems pretty likely that the Fed wants to cut so far this year. If we're looking at their projections, they stuck to those projections. They're not going to update them again until September. So unless something meaningfully changes in terms of inflation, it seems like they're leaning towards resuming those rate cuts in September. But if there is a big spike in inflation, if unemployment remains low, perhaps maybe we only see one cut this year. And if inflation is much higher than people are expecting, maybe we see none. So in the short term, July seems like, as of today, no chance of a rate cut, or at least a very low rate cut chance. But looking out further, the bias is still towards easing. The Fed seems to believe that they'll have room to cut 2 times this year and a few more times in 2026. Okay, let's move on to real estate and the housing market. Let's start out with the real estate, looking at REITs, the VNQ ETF. So very different than the S&P 500. We're seeing it's still in a drawdown here, never recovered from its peak in early 2022. Still in a drawdown here, while the S&P 500, of course, hit all of those all-time highs last year. and hit a few this year as well. S&P 2% off of its peak from back in February. We're still looking at the real estate ETF here down 12% from early 2022 levels. And what's driving that in big part is simply the prices of commercial real estate overall are still in a sizable drawdown as compared to back in 2022. You can see here down 17.6% from that peak level, but you can see the past 12 months, we're actually seeing it start to claw out of that drawdown up about 4% over that period of time. If we're looking at the real estate ETF versus the S&P 500 over the past decade, you can see the downtrend here. So just underperforming the U.S. stock market over that period of time and languishing near the low levels in terms of the past 10 years on this relative strength. If we look at the housing market here, very interesting to see housing affordability just stuck. So what I've been talking about is month after month, it's the same issue in the housing market. Prices continue to go up more than inflation. So housing is becoming less and less affordable. Prices are going up more than people's wages. And if we look at the past decade, you can see the huge gap here. This has created an affordability crisis, and it's really the least affordable housing market in history. So even worse than what we saw during the housing bubble of the 2000s. And the reason for that is home prices up 94% over the last decade, more than double the increase in average hourly earnings at about 45%. And you can see in terms of what you would need to spend of your median income on a housing payment, and this is looking at new homes to purchase, we're in the threshold here that's above where we were back in 2006 during the peak of the last housing bubble. So over 45% of your income would need to go to the purchase of a home to afford that median priced home for sale in the U.S. Extremely unaffordable. Needless to say, you can't get a mortgage if you're going to be saying you're going to spend 45% of your income on that housing payment. And so therefore, we've seen a collapse in demand in terms of the housing market, but we also saw a collapse in terms of supply, but that's slowly starting to change. And what we're seeing in terms of affordability is just a crazy increase over the past 5 years, 90% higher in terms of that monthly payment. And in terms of supply, we're seeing a slow but gradual improvement here, up 15% year over year in terms of the active listings of homes for sale in the U.S. So this is a good sign, higher than it was last year higher than the year before, finally starting to normalize. So that lock-in effect that we saw of people not listing because they were locked into a low mortgage rate, that's starting to ease here. It also seems like it's taking longer for homes on the market to sell, so that's adding to supply as well. So my projection, if we're just playing this out for the rest of the year, we're going to see continued deceleration in terms of home price appreciation because of this unaffordability factor and because we're seeing supply come back onto the market. So lower your expectations for sure in terms of home prices over the next 5 to 10 years. Let's move over to rents here. Very different story than the housing market to purchase is the housing market for rents. And you can see rents peaked back in August 2022, and we have rents today lower than they were back then. So unlike home prices, which continue to go up from that period of time in 2022, we've actually seen rents lower over the past few years, and now we're looking at 24 straight months of year-over-year declines in terms of monthly rents in the U.S. So that's making rents more affordable because over this period of time, you have people's wages going up. So the good news in the rental market is supply is outweighing demand, and that's causing rents to come down in terms of the year-over-year prices. And then we're seeing the vacancies at the highest level on record here, about 7% in terms of apartment vacancies, according to apartment lists. So good news is if you're waiting to buy a home, Rental market very much becoming more and more affordable every single month because wages are outpacing the increase in rents. We're actually seeing, on average, rents actually go down because of this high supply situation. Let's talk about commodities here. And the big story in 2025 so far is, of course, gold up 29% year to date. It's on pace for its best year since 1979, so which was, of course, a record year for gold. Not expected to continue at this pace, obviously, but extremely strong year for gold. Why is gold doing so well? It's always a narrative type asset, but really the story has been the uncertainty that tariffs have brought about, the decline in the dollar, a number of different factors driving sentiment for gold higher. And interesting to see here, gold in terms of inflation adjusted prices just this year passed its prior high from January 1980. So comparing gold to inflation, it peaked back in 1980. It was a historic run up to the peak in 1980. And then you can see just a huge drawdown relative to inflation. So basically, gold was not keeping pace with inflation over this long period of time. And that in the past few years, you can see this huge outperformance, gold doing better than inflation, leading to this new high in inflation adjusted gold prices. Now let's take a look at gold versus the broad commodities ETF. And you can see here gold outperforming this year, outperforming over the last year. And over the last 15 years, there's been no comparison. Gold far outperforming a broad commodity exposure. If we look at the last 10 years, stocks still doing better than gold in the US, up 234%. We got the gold ETF 169%, and then broad commodities up 50%. And that broad commodities exposure for an investor has really done nothing since this ETF came out in the 2000s, still only up a little bit over this period of time, which is kind of remarkable. It's about 20-year period here where broad commodities exposure has done nothing. So very different. Gold, of course, has done extremely well over this period of time, but the average commodity within this index, which is driven primarily by things like crude oil and Brent oil, has not done well over this period of time. And if we look at commodities in the past year, what have been the standout performers? Natural gas up 45%. Then you have gold 43%, coffee up 38%, lumber up 30%, silver here up 20%. You can see on the flip side, crude oil down, Brent and WTI crude oil, gasoline down. So still down year over year, despite the fact that we've seen crude oil spike over the past few weeks due to that situation with Israel and Iran. So that'll be interesting to watch if this flips over into the positive territory for crude oil and gasoline. That's going to have an impact on CPI. So that's really been helping keep inflation down, is the fact that crude oil and gasoline have been lower on a year-over-year basis. So something to watch there if that changes. And I'm not on that point looking at just gas prices here, still lower than a year ago at $3.22 a gallon. But you can see a week ago, the difference here, $3.13 to $3.22. And if crude oil prices remain where they are, we're going to continue to see gas prices trend up. So definitely something to watch. And this will likely push the inflation number for June higher if crude oil stays where it is. And if it continues to rise, obviously, that will create even additional pressure to the upside. Let's talk about currencies here. Historic move so far this year in the dollar index, lower. This is reversing what we saw last year, which was dollar strength. We're seeing dollar weakness, down 9% year to date. And just looking back to the dollar index, started in 1973. This is the worst start to a year that I could find in history. So at this point in time, not the worst year ever if we're looking at a full year, but down 9% at this point in time is the worst start to a year for the dollar index ever. If you look at the last decade, though, dollar index still higher than it was a decade ago. So definitely not the case that this is a continuation of a trend, but lowest level we've seen for the index since 2022, so a few year low here. And if we look at the dollar index since its inception back in March of 1973, pretty much where it was then. So we've seen huge rallies in the dollar. We've seen huge declines in the dollar index. We've seen this cycle back and forth. And where it is today is where it was back in 1973. And so overall, not a huge change, but of course, there have been trends in both directions. And the past decade plus, still dollar index higher than where it was before. Now, what are the different factors driving the dollar, driving the currency markets? Well, you have a lot of different factors. One of those factors being interest rates. So it's interesting to see the dollar index decline, in my view, despite the fact that the U.S. central bank policy has been much more restrictive, higher interest rates than the Eurozone, the ECB, and the Bank of Japan. You can see here the Bank of Japan still running a pretty sharp negative real yield here, -3%. The Eurozone is almost flat in terms of its real central bank rate, and the U.S. Fed is still at 2%. So the expectations seem to be that this is going to change. Of course, if the Fed resumes cutting interest rates this year and it brings it down 0.5%, this will, of course, change. And I think the expectations also that Bank of Japan at some point is going to continue hiking interest rates to normalize these levels, considering where their inflation is, which is actually higher than it is in the U.S. The other side is, of course, growth rates, and the U.S. has, and we'll talk about that in the economy section, but definitely seen a deceleration in growth, but 2.1% year over year, still higher than Japan and the Eurozone. So interesting to see with currencies. You get this type of movement. I guess the expectation from investors is not just based on growth, not just based on interest rates, but also on flows. And what we've seen so far this year, obviously, is outflows in terms of investment from the U.S. in part due to that tariff policy. That's definitely driving the dollar index lower year to date, but we'll see what happens in the back half. If interest rates stay where they are and the U.S. central bank remains much tighter than these other central banks, and you have higher interest rates, we could see the dollar recover those losses very quickly. Okay, let's talk about crypto here. Bitcoin, Ethereum, the two biggest crypto assets in the market, 73% of the crypto market in just these two assets. But you can see big diversion in terms of Bitcoin versus Ethereum here. Bitcoin hitting a new all-time high again this year, recovering from that big correction it had at the April lows. So it was a bigger correction than the equity markets, down over 30%. It recovered fully, hit a record high. You can see Ethereum here has definitely recovered, but nowhere near its high. It actually peaked back in 2021. So what we're seeing here is Bitcoin taking share from the rest of the crypto market here. This is Bitcoin in orange here. Now 64% of the crypto market in Bitcoin. That's up from 39% in November 2022. And here's my table of Bitcoin all-time highs. 110 and 111,000 reached in May, so recovering from that drawdown. Prior to that, the all-time high was in January 20th. Then we had this correction here, which took Bitcoin down 32%, and it took a 47% rally to hit a new high, 121 trading days. Bitcoin year to date up 12% here as I'm talking, following two obviously very strong years for the Bitcoin asset class. Bitcoin, like gold, trading on sentiment more than anything else. What's helped Bitcoin this year, besides the decline in the dollar, is definitely talk about the potential increase in U.S. national debt, deficit, the new bill that's going on there. And I would also say the fact that the Federal Reserve has resumed its money printing. If you're looking at the M2 money supply, now trending up as well. All of these factors helping the narrative for Bitcoin. Let's talk about intermarket analysis here, looking at different asset classes in relation to one another, and stocks versus bonds. You can see over the past decade, Stocks trouncing bonds, not even close. We had this little correction here where stocks underperformed. That was during the bear market, obviously, of late, and then the recovery in the S&P 500. Since then, they're about even now on the year. Bonds outperforming by a little bit. Stock bond correlation coming into the year was at a record high, but you can see here slowly moving in the other direction. So losing that correlation. And I argued a few months ago that was likely to happen. We were likely to see this correlation start to break down because there's less of a fear about inflation being the primary fear in the market. And as that shifts and the primary fear becomes a fear of recession, well, then you really start to have a breakdown, because if we have a recession, then you're likely to see lower interest rates. Bonds respond well to that in terms of rallying, and stocks, of course, not responding well because of an expectation of a hit to earnings. And you can see over the past year, the correlation really breaking down here on a year-over-year basis at 0.22. So this record almost correlation, definitely record on a 3-year basis, seems to be moving in the opposite direction. Bonds, once again, being a diversifier during that decline in April, we saw the bond market proving its worth, acting as a hedge against that stock exposure. If we look at the past 3 years, there's really no comparison. Even though the correlation is pretty high, correlation doesn't equal returns. And you can see here, the US stock market up 69% over the past 3 years, while the bond market up only 8%. So bond market clawing its way out of that drawdown. S&P 500 all of last year hitting a number of all-time highs. Very good 3-year period coming out of that 2022 bear market. If we're looking at stocks versus commodities here, stocks sharply outperform. We show that chart earlier. You can see here coming out of the 2022 bear market, where commodities obviously were performing very strong during that period because you had that huge spike in commodity prices. But since then, stocks outperforming by a wide margin. Gold is different than broad commodities, trades differently. And you can see here, stocks still outperforming gold over the last decade, but it's getting closer in terms of the performance. And in year to date, gold obviously having one of its best years in history, so outperforming this year in terms of the stock market. And Bitcoin versus the S&P 500 is really just a chart of Bitcoin, because Bitcoin's volatility is multiples of the US equity market. So whatever Bitcoin's doing pretty much dominates this chart. But interesting to see that it's hit a new record high with that recent rally in Bitcoin. So Bitcoin recovering fully from its bear market earlier this year, but the US equity market hasn't recovered fully just yet. But if we're looking at Bitcoin versus the stock market, you can see not that far above where it was during the 2021 huge spike in the price of Bitcoin. Then there was obviously that big correction. So overall, Bitcoin outperforming the S&P 500 a little bit this year, but the big standout has been gold, leading all asset classes so far this year. And as we talked about, small caps still lagging by the most. US small caps down in the red here, but everything else pretty much positive. If we're looking at the bonds area of the market, we're seeing bond returns up in terms of high yield bonds, investment grade bonds, overall bond market. And if we're looking at commodities here, up 8%. So most asset classes, 86% of the major asset classes positive so far this year. Let's end here with the US economy. And there's a big debate, of course, over the economy. Is it going into recession? A few months ago, many people were claiming we're definitely headed for a recession. Now, much fewer people. So the data is changing very quickly here. So entering the year, we were at 57 months in terms of the expansion. Then we got that negative GDP print in the first quarter, negative 0.2% annualized, not a big decline, and it was entirely due to the import-export situation with net exports really driving that with a huge negative number there because companies were front running the tariffs by buying a huge amount of imports. So really a technical decline, but we didn't see really any weakness in terms of consumer spending or other factors in terms of this negative print. So for the second quarter, what seems likely so far based on the data is we're going to see much of that negative print reverse. So the Atlanta Fed is currently projecting 3.4% in terms of that second quarter number. And what's driving that is a reversal of the net export number. So they're saying it's going to actually contribute 2% to GDP in the second quarter. And the reason for that is the deficit has come way down. So what we're seeing is much fewer imports in terms of international trade for the second quarter. So that's reversing what happened in the first quarter. So very confusing picture here. Obviously, the full impact of tariffs, we don't really know because we don't yet have deals with the major countries. We know that it's in a better place than it was in early April, but we don't know where it's actually going to settle in terms of China, Mexico, Canada. We don't really have any certainty there in terms of any of that as it stands right now. But what the market seems to be saying right now, if we're just looking at the stock market, is there isn't going to be a big impact in terms of a hit to earnings in terms of the expectations. So it seems to be the market, and you could say it's being too optimistic, is saying this is going to resolve itself in a positive enough fashion, and even if it is negative, then those policies will quickly change as they were in April. That seems to be the expectation, the way I'm reading it today. In terms of the jobs market, obviously this is hugely important. What's driving consumer spending? It's the fact that jobs market is continuing to grow, 53rd consecutive month in May. What we're seeing, though, is a slowdown in terms of that growth rate. So what I've been talking about is the labor market is cooling. We're starting to see more evidence of that. Looking at initial jobless claims are starting to tick up here, and that's something definitely to watch closely in the coming weeks. I'll be talking about that more and more. We're seeing continued claims for unemployment also start to tick up, which is a sign that perhaps it's becoming more difficult for people that are laid off to find a new job as well. But if you're looking at the overall U.S. unemployment rate, still remains pretty low here, 4.2%, well below the historical average of 5.7%. Of course, the Fed looking at this number very closely, Powell referring to it a number of times. So if this is going to tick up in the coming months, that would definitely seem to flip the Fed's thinking in terms of that balance between maximum employment and price stability, and lean the Fed into thinking more about that employment picture and therefore cutting interest rates even if we see inflation go up. So if the big question in terms of the economy and growth is what's going to happen in terms of tax policy and spending policy, and the bill is currently sitting with the Senate right now, and there are changes being made. The expectation is that they'll come to some type of resolution here, but the big question will be what's going to be the impact on the deficit? What will that spending number end up being? Are we going to continue to be running $2 trillion deficits? If it stays the way it is in terms of the House bill, we could see an increase in the deficit, and there seems to be a fight going on to try to maybe cut more spending or change that so it's at least neutral to where it is. But it doesn't seem very likely the way it stands right now that we're going to see a major reduction in the deficit number. So what that essentially means is the spending number here, we're looking at 7.1 trillion over the past year in terms of government spending. It doesn't seem very likely that number is going to be cut at all, likely to be higher a year from now than it is today. And the big question will be with the tax revenue, is it going to in the short run go down because of those new tax cuts that they're putting into the bill? We're going to see lower revenue. Well, that could increase the deficit as well. So let's end with something positive, as I always do. And I think this is the biggest driver, most important chart for an economy, biggest driver of the continued expansion, continued growth in terms of consumer spending and retail sales being better than expected this year, is the fact that hourly earnings have been outpacing inflation now for 25 consecutive months on a year-over-year basis, a 1.4% spread. And that's the opposite of what we saw prior to that, which was 25 consecutive months of negative real wage growth. So great news for the American worker. Hopefully this continues in the months to come. This is the best thing you can say about the economy right now, is that wage growth, so wages for US workers, is outpacing the inflation. If we're looking at CPI, 2.4% over the past year, while wage growth has been above 3.8% in the past year. And that spread is putting more money in people's pockets to save, to invest, and to spend. Okay, let's end it right there. Thanks everyone for joining me on this special edition of the Week in Charts called The State of the Markets. If you're watching this on YouTube, take a quick moment, hit that subscribe button, and I'll see you next time on the Week in Charts.